Something strange happens when you look closely at Japan and the US. I mean, when you really look at their economic moves side by side,
Mhm.
you start to realize that both of these giants, I mean, two of the world's most powerful economies, are caught. They're caught in what looks like a sophisticated, self-imposed trap.
And it's not even a single trap, right? It's more like a series of policy choices that are all feeding into each other. We're
Mhm.
talking about massive debt-fueled government spending happening right alongside this very targeted protectionism and some really complex geopolitical games.
And the crazy part is these policies are supposed to help. They're meant to create growth, protect jobs.
But the immediate effect is, well, it's the opposite. It's wrecking major currencies, it's collapsing industrial competitiveness, and it's putting central banks in a position that is, frankly, impossible.
Exactly. So our mission today is a very, very deep dive into these decisions coming out of Tokyo and Washington. We're going to unpack Japan's new, what is it, $110 billion stimulus package.
That's the one.
And we're going to put that right up against what's happening in the U.S., the escalating tariffs, the promise of new helicopter money.
And when you do that, when you compare them, you see these serious structural weaknesses. You see a level of global interconnectedness that, the policymakers in both capitals seem almost determined to ignore.
Mm-hmm.
So our goal for you, listening to this, is to really extract the critical insights. We want to understand the causal mechanism here. Why is all this massive spending, which is, sold to everyone as a necessary boost,
Right.
why is it instead leading to a currency crisis in Asia? And why are tariffs, which are supposed to save manufacturing, becoming this self-inflicted wound for American industry?
It all boils down to one key question, really, a question that I think defines the whole modern economy. How long can major economies run on just more and more debt and spending before the basics, affordable inputs, and accessible markets, before they become impossible luxuries?
That's the question, and I think we're about to find out.
Let's start in Tokyo then, because the news there is it's pretty shocking, especially given Japan's recent history. For decades, they were the poster child for low rates for QE,
Hmm.
and now they've officially jumped back into the global money printing spree. There's a major new stimulus package confirmed.
The scale is, it's staggering, especially when you remember the debt they're already carrying.
Yeah.
The finance minister confirmed it's going to exceed 17 trillion yen.
17 trillion.
Yeah, which translates to, like you said, about 110 billion US dollars. This isn't just a small tweak. This is a major financial event for an economy that's been struggling with stagnation for, 30 years?
And the official reason for it? It almost sounds like a paradox, doesn't it?
It really does,
They say it's to cushion the rising cost of living.
which money printing makes worse.
Exactly. And to boost investment in things like AI and semiconductors, it just feels, I don't know, like a Hail Mary.
It is absolutely a desperate move, and you can tell by how the global markets reacted. They're not buying it. The root of this isn't just domestic. You have to look at the global picture.
Okay.
Japan is doing this at a time when the whole world is already superheated with cash.
Hmm.
You've got the U.S. running these enormous, nearly $2 trillion deficits.
Right.
You've got China injecting its own massive stimulus to fight the trade war and prop up its economy. It's like a monetary arms race, and Japan felt like they had to push all their chips in. They're more scared of shrinking than they are of inflating.
But the immediate result of printing over $100 billion is, well, it's predictable.
Completely.
You wreck your currency, we're seeing that with the yen,
Oh.
and you smash your bond market because you have to issue all this new debt to fund it.
And that's where you really see the confidence crisis. That's the tell. Investors are not buying the story that this spending leads to growth. And we have a really crucial data point here.
What's that?
Japan's 20-year bond yield, it is erupting. It's heading toward 2.8%.
And for Japan, that number that's huge, right?
It's the highest level in recorded history. For a country whose central bank has spent decades pinning yields down to basically zero, 2.8% is a scream.
So what does that actually signify? When a yield jumps like that, what is the market saying?
It's saying that confidence in the yen is eroding fast. When investors demand a much higher rate of return to hold your government's debt, they are pricing in risk.
Risk of what? Inflation? Default.
Both. First, the risk that the government will just keep printing and spending and that inflation will eat away the value of their bonds. And second, the risk that they just can't pay it back. I mean, you have to remember, Japan's debt-to-GDP ratio is already over 230%.
230%.
It's the highest in the developed world. So when the cost of servicing that mountain of debt jumps from near zero to almost 3%, the government's annual interest payment just skyrockets. The bond market is signaling that this is just not sustainable.
And the market skepticism seems pretty justified given the recent numbers. We saw Japan's GDP actually crash by 1.8% in the third quarter. That was the first decline in, what, 6 quarters?
And that Q3 number, that is a massive warning flare. It tells you that the global slowdown, especially in China, and the effects of tariffs, it's all starting to bite.
So a recession is a real possibility.
But 1.8% contraction is severe. If Q4 is also negative, Japan is officially in a recession. And the key thing is, this $100 billion stimulus isn't going into a healthy system, it's going into a fragile one, so you don't get growth.
You just get inflation and instability.
Exactly. The real economy can't absorb it productively.
And on top of all this economic weakness, you have this incredibly dangerous geopolitical situation brewing.
This is what makes it the perfect storm.
A confrontation with Beijing.
Right. The economic weakness is being amplified by this looming fight, and it all revolves around Taiwan. There were some critical comments from a senior official, Tai Chi, who's the head of their National Security Secretariat.
And Beijing saw those comments as crossing a line.
A definite red line. They were interpreted as Japan hinting at getting involved militarily in a conflict over Taiwan.
Why is that so volatile?
Well, it touches on extremely sensitive history from World War II. And it also goes against the official one China policy that Japan and the U.S. are supposed to follow. When a top Japanese official says something like that, China sees it as direct interference. It puts the whole system at risk.
And China's not just talking, their state media is already hinting at retaliation.
Economic retaliation. This is the real danger for Japan. It could be sanctions. More likely, though, it would be restricting trade or cutting off supplies of critical goods or even just stopping tourism.
Which would be devastating.
It would be devastating. Japan's heavy industries are already paying more for everything because the yen is so weak. They absolutely rely on stable trade with China. So if China puts the squeeze on top of everything else, the whole stimulus plan could fall apart before it even gets going.
So they're spending money they don't have while picking a fight with their biggest supplier.
It's a masterclass in contradictions.
That contradiction is the perfect transition. This trade war, this new geopolitical stance, it puts Japan at a huge disadvantage because they need China. Maybe more than China needs them, at least in certain critical areas.
That reliance gives Beijing enormous leverage. And it's not abstract leverage, it's very concrete. We can break it down into two clear leverage points, starting with tourism.
Tourism. Most people think of it as, a nice bonus for an economy, but for Japan, it's critical.
It's absolutely critical. Tourism makes up about 7% of Japan's entire economy. That's a huge slice.
So China holds leverage just by what? Telling its people not to go.
Pretty much. They can issue travel warnings, have state media stop promoting Japan, tighten up visas. It's a fast, non-military weapon that has an instant effect on the market.
Let's put some numbers on that so we can feel the scale.
Okay, get this. In the first 9 months of the year, just visitors from mainland China, 7.5 million people.
7.5 million.
Yeah. And if you add in visitors from Hong Kong, you're looking at nearly 9.3 million. That number, nearly 10 million people, is more than the tourists from South Korea and the U.S. combined.
So if China just turns off that tap, what happens?
The impact is instantaneous. And it's massive, especially for consumer brands. Chinese tourists spend a lot of money, especially on luxury goods, cosmetics. We saw a perfect example. A company like Shiseido. Their stock price crashed 9% in a single day.
Just based on rumors.
Just based on rumors and signals that Chinese consumer sentiment was shifting. That's how fast and how powerful this leverage is.
So that's the consumer side. But you said there was a second, maybe even more fundamental leverage point.
Yes. And this one ties directly back to that big stimulus package. It's about critical minerals and industrial inputs.
So the very semiconductor industry they're trying to build
is completely dependent on affordable inputs from the country they are now antagonizing.
That's the core paradox, then.
It's the core strategic paradox of their whole policy. You can spend billions building a fancy new chip factory, but that factory needs raw materials to run. And to be competitive, those materials have to be affordable. And for Japan's automakers, their electronics sector, all these new high-tech industries, those materials come from China.
How much control does China actually have over these supply chains? Is it really a monopoly?
It's a near monopoly. This is why decoupling is so hard and so expensive. For certain crucial minerals like gallium, magnesium, graphite, China controls nearly 100% of the market. These are essential for EV batteries, for example.
And for chips.
For chips and for things like the high-performance magnets you need in advanced electronics, you need minerals like indium. China controls 70% of that supply chain.
So Japan is spending $110 billion to build up its own chip industry.
While the affordable ingredients for that industry are controlled by Beijing.
It seems like strategic futility, at least in the short term.
It is. Building a chip plant takes years. Building a new, diversified, affordable supply chain for rare earths. That takes decades and massive investment. Japan is funding the output without securing the inputs. And they're picking a geopolitical fight right when their economy is most vulnerable on the input side.
So you can print the money, but you can't print a secure supply chain overnight.
Exactly. It all comes back to affordable inputs and accessible markets. And for Japan, right now, China holds the keys to both.
Speaking of affordable inputs, if Japan is struggling with antagonizing its supplier, let's pivot to the United States. Because the U.S. is facing its own equally complex, self-imposed crisis.
Right.
Their whole attempt at reindustrialization, all this stuff fueled by tariffs, it's on the brink of collapse because of soaring costs. I call it the Hotel California trap.
The Hotel California trap. I like that. So the idea behind the tariffs was, protect American jobs, bring manufacturing home, made in America.
Right, and also generate revenue for the government.
But the reality is, it's doing one but not the other. It's achieving the revenue goal, but it's simultaneously destroying the very industries it's supposed to save. The irony is it's profound.
How so?
The U.S. is basically making it too expensive to manufacture things in the U.S. If you're a company and you want to build a new data center or a chip plant with cheap PCS, ag money, or an EV factory, the tariffs are just adding layer after layer of cost that makes you uncompetitive.
Give me a concrete example. Let's look at a key material like aluminum.
Aluminum is the perfect example. It's crucial for everything. Construction, cars, you name it. You have to look at what's called the Midwest premium for aluminum. This isn't the global price of the metal.
It's an extra charge.
It's a massive extra charge you have to pay on top of the world price just to get it delivered in the U.S.
Yeah.
And because of the tariffs, that premium has gone completely ballistic. We're talking an extra $2,000 per ton.
$2,000 extra. So why is that happening?
Because the tariffs wall off the U.S. from the global supply. Domestic producers can't keep up with demand, so the few importers who are left can charge whatever they want. People in the market are calling the U.S. aluminum market all but broken. Stockpiles are shrinking, prices are jumping. It's chaos.
And the direct consequence for U.S. manufacturing is?
It's a disaster. First, making anything in the U.S., like an EV, costs a ton more. And who pays for that? The U.S. consumer, who's forced to buy American at a huge premium?
And second,
and this is maybe even worse, U.S. exports become instantly uncompetitive. Why would anyone in Europe or Asia buy a U.S.-made product when the aluminum or steel inside it costs double?
So global suppliers are just avoiding the U.S. market.
Exactly. They're sending their aluminum to Europe where prices are normal. It's not a sustainable way to reindustrialize.
And it's not just aluminum. You said it's across the board.
Oh, absolutely. Steel, copper, the bedrock materials for any industrial economy. They're also taxed at over 30%. Think about the AI race. The U.S. wants to win the AI race. That's going to take over $1 trillion in spending on data centers, power grids, new fabs.
And all of that spending will be done at a premium.
At a huge premium. Because the structural steel, the copper wiring, all the necessary inputs are being taxed by their own government's policies.
And can the U.S. even sustain this when its basic infrastructure is already crumbling?
That's the other part of the trap. That's the infrastructure black hole.
Yeah.
You can't have a competitive industrial economy if you can't even move your products efficiently or power your factories reliably. The U.S. has a funding gap of over $3.7 trillion for its infrastructure.
$3.7 trillion. Break that down for me.
Okay, so you're looking at $580 billion just for the energy grid. You need that for the new chip fabs.
Right.
Then you've got $690 billion for roads, $370 billion for bridges. If you make an expensive EV, and then it gets stuck on a congested, crumbling road, that inefficiency just adds to the final price.
So if you put it all together, the U.S. is in a situation where it has to spend, what, $2 to get $1 of competitive output?
That's the trap. That's the Hotel California. Once you check into this system of high tariffs and high internal costs.
You can check out anytime you like, but you can never leave.
Exactly. Because undoing it is too painful politically, the protected industries would scream. So they're forced to just double down.
And the crazy train of spending isn't stopping there.
Not even close.
Now we're hearing confirmation of a new wave of helicopter money. This time they're calling it a tariff dividend.
That's right. The $2,000 dividend checks, they're confirmed, and they're set to hit mailboxes by mid-2026. And it's a very specific politically targeted move. It's for families making less than $100,000 a year.
The justification is clever. They're saying the money from the tariffs is paying for this. It's a rebate.
It's a great way to mask the debt reality. Because while the tariffs do bring in revenue, this move alone will require at least $300 billion in new borrowing.
Some estimates are even higher.
Some are as high as $600 billion, yeah. And that's more than the tariffs have collected so far. So this is not a windfall. It's new deficit finance spending.
And it's incredibly inflationary, disguised as a popular handout.
It's a politically surgical move.
Yeah.
And yes, it is almost certainly inflationary in the short term. When millions of people get a check like that, they're going to go out and spend it. That surge in demand pushes up prices.
So let's follow the money. Where does that $300 to $600 billion ultimately end up?
This is where we get into the asset melt-up, the Cantillon effect. This new money doesn't spread evenly. It flows through the economy, right? It inflates consumer prices for a bit. But the profits from all that spending, they flow up. They flow to the people who own the companies, the people who own the assets.
So temporary relief for the working class, long-term gain for the wealthy.
Precisely. After the cash moves through the retail sector, where do the profits go? They go into buying assets, real estate, gold, stocks. This stimulus is basically rocket fuel for asset prices. You inject cash at the bottom, but the lasting financial benefit collects at the top.
So it's an intentional asset melt-up driven by fiscal policy.
It creates this dual economy. You can call it, bread and circus for the masses. The checks keep people happy for a while.
While also funding a new house for the upper echelons.
Exactly. It widens that K-shaped recovery we always talk about. And the market sees this coming.
It's already pricing it in.
It's already pricing in this huge flood of new money and debt. And that makes life very, very difficult for the Federal Reserve.
And that's the point where it all connects, where this absurd fiscal policy runs head-on into monetary policy. This potential $600 billion of new spending. It completely messes with the Fed's decision-making on interest rates.
This is the classic Fed trap, just amplified by political recklessness. The administration is basically confirming that a new wave of inflation is coming down the pipe in 2026.
So Fed Chair Powell and his colleagues are stuck.
They're stuck between two terrible choices.
Okay, lay out the trap from their perspective.
All right. If they cut interest rates now, based on today's data, they risk feeding a much bigger inflation surge down the road when that $600 billion hits.
They'd be pouring gasoline on a fire that's about to be lit.
Exactly. They'd be going directly against their mandate for price stability. But if they don't cut rates, they risk choking off growth right now and facing a huge political backlash.
And the market sees this risk, right? We've seen it in the odds of a rate cut.
Immediately, the odds of no cut have surged to over 50%. And to make it worse, the Fed has been dealing with things like data blackouts from government shutdowns. They're flying blind while the government is loading the plane with fiscal explosives.
Meanwhile, you've got a huge part of the stock market, especially big tech, that is desperate for rate cuts.
The bubble needs it. It's undisputed. Big tech needs cheap capital to fund everything. New data centers, R&D acquisitions. When rates are high, their future profits are worth less today. It kills their valuations. They need the cuts to keep the growth story alive.
So the Fed is getting pressure from Wall Street and the White House to cut.
While their own models are screaming about future inflation from that same White House's spending.
It's an impossible position.
It is. Does the Fed have the courage to hold the line on inflation when the administration is about to unleash a $600 billion tsunami of cash? Cutting rates now would be, from a price stability standpoint, fundamentally irresponsible.
So when you look at the whole picture, the fiscal mess, the industrial traps, the central bank's dilemma, the final assessment is?
It's a joke. I mean, the whole economy is a comedy show. It's a macroeconomic spectacle built on contradictions and nonsense and just insanity. It's a sandwich from hell. And while it's fascinating to watch, you can't run this shell game forever. Eventually, the market decides it's had enough. And that will be the moment of reckoning for both Tokyo and Washington.
So let's just synthesize these traps for everyone one last time.
Okay.
On one side, you have Japan. They're caught in a debt stimulus cycle that's wrecking their bond market. And their big plan to boost tech is being undermined by their reliance on China for both parts and customers.
Right. And on the other side, you have the U.S. caught in its own tariff trap, Protectionism is making its own industry uncompetitive by driving up costs. And on top of that, political stimulus is threatening a new inflation wave and completely trapping the central bank.
So the key takeaway here for you listening is that stability is it's not on the menu.
Not at all.
The core problem for both of them isn't a lack of money. They can print endless amounts of that. It's a lack of affordable inputs and accessible markets.
And both of those things are now controlled by geopolitics and their own bad policies. They're fighting a trade war and a debt war at the same time, using the same limited resource-printed money to fight both.
Which leads to a final provocative thought.
Given that neither Tokyo nor Washington can politically afford to stop the spending, what critical industrial input, something essential for defense or for the new AI power grid, what will be the next flashpoint? What's the one thing that will finally force one of these economies to face the full, unmasked cost of all this?
The reliance on inputs is the true vulnerability. Think about that as you process this deep dive.